Let's get to one mover and shaker now. He's live at the desk. Martin Crabb from Shaw and Partners is here too. Well, maybe we'll start with the budget, because we were joking off air before that typically these events aren't significant from an investment point of view. Obviously, there's social and economic issues that we'll hear about a lot tomorrow. But as an investor, maybe not too much there that we don't already know.
Yeah, a lot of it's been pre-released,
Yeah.
or the media's been given, the key issues. There's a surplus, which is great. We haven't had a surplus for 15 years. So there's people alive watching this show who've never seen a surplus. So that's good news. And the fact that the government gets that it needs to fight inflation, as you were talking about, Joe Biden said, well, I don't care. I'm spending, 40 billion or whatever it is. And we had that infamous UK government that came out with a stimulatory government, lasted a little less than a lettuce. So it's really good in Australia that we've got alignment between what the Reserve Bank's trying to do and what the government's trying to do, which is fight inflation. So that's a very good news story, because if you've got a stimulatory government, then the RBA has to go harder. So there's a little bit of an element of that in the interest rate market. It feels like we're moving back from this notion of central banks cutting rates. It's just clear that the economy is too strong. One of the reasons we've got a surplus is the economy is so strong. Everyone's got a job. Wages are growing. The Aubiz data on spending today, we're still spending 10% more than we were a year ago. We're spending 40% more at restaurants and cafes than we were a year ago. So where's the cliff? There's no sign of the cliff. So you just get this feeling that the budget will display this narrative as well, as the government is spending money. It's spending less fast than the money's coming in, but it's still expanding. So that's
no, fair enough. Might just loop back to the banking results, because you have seen some of the banks now withdraw from that fighting it out in the mortgage market, and I think CBA has also pulled its claws in, so to speak. How did you see the results?
Yeah, I mean, I think the rally today is interesting because there wasn't any good news in the results. There weren't like beats or anything like that. Maybe Westpac was a slight beat. There was a little bit of an upgrade there, but CBA was a little bit light on. I think it's just a relief rally. Like, all the bad news is now in the market. You're sort of going to the bank results going, they're going to be horrible, they're going to be horrible. CBA was leading the mortgage war. They have a digital brand called Unloan. So if you want to refinance and you're 80% LVR and owner occupied, you can get a really, really sharp rate through them. So that's their digital challenger bank. So they were leading the price war. The fact that they've said, oh, we're stepping away from competition, I think that's probably good news for bank shareholders. He made the point, Kyle, that the dividend yields at these levels have got to provide some sort of price support. So it doesn't feel like the market's going to roar away. So the banks will give you, close to 10% grossed up income if you can use the franking credits, and then maybe a little bit of capital growth. So they don't look that bad. So we were very underweight the banks just going to these results because we thought they were going to be tough, and we are at peak bank earnings. There's no doubt about that. The bank sector tends to follow earnings, so we've got a chart that goes back to 87, and you can just overlay the share prices of the banks against the earnings per share, and it does look like it's peaked. So there it is there. So, surprise, surprise, bank share prices follow bank earnings. In fact, they lead them, and it just looks like the black line is just rolling over, which is earnings per share. So we're probably reaching peak earnings with these results, and we'll see downgrades going forward as the economy slows, as bad and doubtful debts start to pick up, and as credit growth continues to slow. The banks will be under further pressure. So we don't think it's a capital growth story, but it is an equity income story. You should get reasonably good dividend income out of the banking sector going forward.
Yeah.
Potentially. Oh, sorry, Danny.
No, I was just going to ask, sticking with the financials, what about the insurance sector? Because that has been one of the favourites this year.
That's the long short out there, really, is to go long the insurance stocks and short the banks. So the banks have got earnings headwinds. They've got, as we said, higher bad and doubtful debts, lower net income, whereas insurers are all come upgrades. So we've had a lot of catastrophes, and what tends to happen after catastrophes is premium rates go up. So anyone who's got their home and contents insurance or their motor vehicle insurance will have noticed a staggering 20 or 30% rise in the premium income, which is bizarre, but that's the nature of the beast. It's just capacity. And so there come upgrades. Also, a lot of the insurers in Australia are short tail insurers, which means they basically don't hold the premium income for very long. So they're not invested in the equity market, they're invested in the money market. So as interest rates go up, they get to earn that extra money on the investment side. So, you know, QBE, IAG, Suncorp are all short tail insurers mostly, and so they're benefiting from higher interest rates. So they've got higher premium income and higher investment earnings, so the best of both worlds. So they're seeing earnings upgrades at the time the banking sector's seeing earning downgrades. And you look at the valuations and they look quite similar. They're both on sort of, you know, low double digit, high single digit PEs, whether QBE, Suncorp, IAG and the banks. So for us, it makes sense to be overweight insurance and underweight banks. So banks are about 20% of the index. Insurance is only 3%. We're something like 7 or 8 in insurance and 8 or 9 in banks. That's kind of how we are at the moment. That makes sense to us.
May as well stay on the interest rate theme, I suppose, because we do have the CPI release out of the States on Wednesday night, our time. Might even backtrack and tie in the fact that we had that job starter out on Friday and seemed to spur something of a risk-on rally for markets. I mean, there's an element here that, you know, good news is good news again because of these recession concerns. And I mean, could potentially CPI knock that on the head if it comes in, well, really as sticky as forecasters seem to be assuming?
Yeah, there's a lot of crowding around this 0.3 for core and 0.4 for headline CPI. Almost every commentator I'm looking at is going for that number, which means the risk is on either side of that. Again, this resilient economy and this sticky inflation is the fear that I've got, because if I look at what the market's pricing, it's pricing in rate cuts, 3 rate cuts by the Fed before Christmas. And the Fed's own employment forecast needs 120,000 jobs to disappear every month between here and the end of the year. We just added, 250,000 last week? So we've got to go from plus 250 a month to minus 120 a month for the rest of the year to hit that 4.5% inflation target, unemployment target, which means the next dot plot, which is not till June, will show much higher employment or lower unemployment and probably higher inflation, therefore a higher dot plot. So we are here at the moment, we've got 5% inflation and 3.5% unemployment. So we're still too hot. We're still above the target. And yes, inflation's coming down, but it's not roaring back to 2% anytime soon. So I just think the Fed has more to do, and that doesn't mean they'll go higher. It just means they'll stay where they are for longer. So I think the market's susceptible to what they call, I think it's bear flattening, where the yield curve flattens out at the long end. I think it's called a bear flattening. Maybe some fixed interest experts will let us know what a bear flattening is. So I think we'll see the futures curve to stop pricing in rate cuts and to start pricing in the bank being on hold, both here and in the US. And that means equity markets will probably stay under pressure.
It was interesting, those credit numbers that came out of the US yesterday. I think that they are seeing a contraction in credit, and that was really pre all the super big bank blow up. So do you think that whole narrative that the credit crunch is coming has some legs in the US, and that really could be the factor that tips the economy into the recession?
Yeah, I think that's what everyone's watching now, is that, senior loan officer opinion surveys, or the SLOOs, the SLOOs which everyone's talking about, which is only quarterly, Danny, so it's not fantastically timely. There are some other measures of liquidity and financial conditions that are more timely, but they're all showing the same thing, is that it's getting tougher out there, which you'd expect after the massive interest rate hikes that we've had. But everyone's watching for the next shoe to drop. The key is really that commercial real estate market. So we talked about the REITs earlier being off 1 or 2% here. There's just this nagging fear that real estate's come a 15 to 20% downgrade. And it's a bit like the banks themselves that are carrying treasuries that are down 20%. If they market to market, they become insolvent. If you start mark to marketing the commercial real estate sector in America, there's a lot more banks that look in trouble. And remember, there's 4,500 banks. There used to be 14,000, but there's 4,500 banks. So there's probably a good chance a couple of them have got themselves into a bit of trouble. So the market's looking for the next shoe to drop. And that's going to keep people nervous, I think. So like the phases of the GFC, at the start it was a rate story, and then it became a credit story, and then it became a solvency story, and then it became a financial system stability story. So it evolved into something quite horrible. And we're going through phases not dissimilar to that, but a much lower magnitude, because obviously you've got the Fed's backstopping the problems. But yeah, I just think markets will stay cautious during this period where we're waiting to see if there's another bank to drop.
Well, cautious we will remain. Martin, thank you so much for your insights. It's
Always a
fantastic as
pleasure.
always, Martin.
Fantastic.
Crabb from Shaw and Partners there.